Let's get to it. Time for the big fat idea. Neil McIver is with me, McIver Capital Management at Richardson GMP. Neil, thanks for taking time on the long weekend. Let's get right to it. What's your big fat idea for us?
Well, good morning, Michael, and great to be with you and your listeners this morning. Well, nearly the biggest mistake we see individual and professional investors alike make is to hold portfolios which are too highly correlated, meaning they have assets which are too much alike and they'll move in the same direction at the same time. So my big fat idea is to mirror exactly what we're doing with our client portfolios right now, and that's to rebalance portfolios and to do so reduce risk in them, basically harvest partial gains and rebalance them back to their original asset mix.
Let's talk just a little bit more about rebalancing. So what would be the goal in that rebalance? I mean, you've given us a hint there when you talk about reducing risk. Can you be a little more specific?
For sure. Well, markets have really performed over the past couple of years. Even our middle-of-the-road P3 portfolio, a conservative value portfolio, has netted clients about 15% as a rate of return. So portfolios are become unbalanced over time. So as an example, imagine you have a portfolio which begins with, let's say, exactly 50% short-term bonds and 50% in stocks. And that portfolio is suited for you and for your risk tolerance and for your financial situation. And then imagine we've got a nice bull market in stocks, and the stock market component of your portfolio after about a year is, let's say, 75% of your portfolio in bonds, and the bond component has now become 25%. And that's not because bonds have fallen in value. It's just because equities, stocks, have risen so much in value. So what do? The portfolio is now much more aggressive than you had originally wanted. It doesn't suit your financial situation or your tolerance for risk. And unfortunately, human nature is such that most people will just leave that portfolio unbalanced and suffer the financial and emotional consequences when a market returns or normalizes over time, basically when it corrects. And the correct thing to do and the disciplined thing to do is to harvest part of those profits, so partially take profits on individual positions on the stock side and bank those, effectively toss those onto the bond and cash side of your portfolio, returning it to its 50-50 mix.
How often should you do this?
Well, that's an excellent question. And really, typically all of the studies have shown that you should really do it annually, typically in the spring as well, too. Annually gives us each asset class or each position enough time to grow, but it's tight enough to ensure that gains are taken before any market reversal comes back and, of course, eliminates those gains. So typically you should do it pretty much every spring. And the reason why we like spring is really because there's a normal seasonality to the market, and that's that markets typically top out in spring. You've heard of sell in May and go away, and then they go sideways through the summer and correct through the fall, and then begin a new cycle late in the fall and early in the winter. So the most efficient time that you want to harvest gains every year is the spring on an annualized basis. And then this particular spring, of course, there's some added incentive with the French elections coming up in just about a week or so.
And just very quickly, so let's say I have Neil, I go to McIver Asset Management, and I've got, let's say, $100,000 with you, but I also have a company pension plan. I don't control it in the same way. It's not an RSP at this point. Should I be looking at what they have too? So let's say they're 100% in bonds. Mm-hmm. Does that impact how I assess my portfolio with you, for example?
Well, it should. I mean, all of it should be looked at as one holistic group of capital. But absolutely, you should go back. Company-sponsored plans are typically where you see a lot of this unbalancing take place. Go to your plan administrator, take a look at your group RSP, whatever it is, take a look at the most recent statement, and talk to them about returning that asset mix back to wherever it was it started. And typically it's going to be something like a 60-40 bond split, something along those lines. And now is the time to do it. Don't wait. This is not something you want to worry about in the summer or in the fall. You want to do it right now.
Yeah, your timing in the spring is very apropos. I got Don Villalobos coming on with me, who deals exactly with that, with seasonality of investments. So, perfect suggestion.
He's a
Neil,
brilliant
thanks
man.
Yeah, it's great stuff. Neil, thank you for taking the time. I know it's a long weekend, but that's very, very important advice. This is like a fundamental of how you should handle your stuff. Thanks, Neil.
My pleasure, Mike. Thank you.
Neil McIver of McIver Capital Management at Richardson GMP.